Good evening all, we are Team Juventus. We are initiating our coverage on PVR with a buy recommendation with a target price of 1310 with an upward potential of 19.1% backed by four major reasons, four key factors. First one, they are market leaders and huge potential to grow. They have best operating matrices and profitability, high margin F&P and advertising income and GST implementation. Let's look at why we are saying that they are the number one player. PVR is the largest multiplex operator in India with a market share of 25%. They have leadership in top six cities of nine out of nine, and over the years we can see their financial position has strengthened. They have a pan-India presence, majorly in the east, majorly in the west and north. However, there are opportunities in the central and east India. They have a diversified product offerings under 9 brands which none of their competitors have. Looking at the comparison of the Indian market along with the global market, we see that Indian market has huge potential to grow as compared to that of USA and Canada. India ranks lowest among the number of screens per million population, despite the fact that highest number of films are being released in the country. When we compare the top 3 global markets, we clearly see that India has still huge potential to grow. The Indian film industry is poised to grow at 10% CAGR by till 2020. Also, if we see the why multiplexes are surviving because of their revenue model as compared to that of the single screens, the the distribution is majorly dominated by the domestic theatre from where they get 74% of their revenue. Across the years, multiplexes are increasing. The average ticket price is poised to be reached at 214 by 2020, which is at 174. Let's look at the comparison. We see that multiplexes are only 17%, but their box office collection is more than that 40%. The multiplexes which are going to come up, they are going to come up in the tier 2 and the tier 3 cities as shown by the analysis. If we look at the Porter 5 forces analysis, the interfirm rivalry and the suppliers power is moderate, whereas the entry barriers are low. However, the buyer's power is moderately high because of low switching costs, and threat of substitute is very high because of Netflix, video on demand, stand-up comedy, etc. So let's look at why we are saying that they have best operating matrices. Before that, we are just looking at the revenue and the expenditure model. They have a diversified revenue where 47% of the revenue comes from other than the box office collection. They have a high operating leverage where 55% of their operating cost is fixed. In screen comparison, we can clearly see PVR is ranked first across the country, and because of higher number of screens, their fixed cost is divided across a large number of screens. The industry has gone on major consolidation in the last 5 years, leaving only 4 key players: PVR, Inox, Carnival, and Cinepolis. If we look at the competitor analysis with the domestic and the international peers, clearly PVR outperforms everybody, and the closest competitor is Inox. However, PVR has 63% higher revenues in FY16 as compared to that of Inox. We say PVR is best because PVR has outperformed across the years Inox across the key industry parameters like revenue per screen, EBITDA per screen, sponsorship revenue, average ticket price, admits, occupancy, and box office collections per screen. Let's look at the internal strength of PVR. The financial leverage has reduced significantly post acquisition of Cinemax and DD Cinemas. Their margins have significantly increased over the years. Debt by EBITDA has become favorable. Cash flow from operations and free cash flows have improved significantly, showing us that they are best across their operating matrices.
Next key factor we'll move on to is high margin F&B and ad income. Why do we say that? So because PVR commands a phenomenal 70% of the advertising revenue for the Indian market, which has grown at a CAGR of 32% because of their innovative strategy of paper eyeball view. Another thing is that they have major share in major locations, which is Maharashtra and Delhi, which accounts for more than 60% of the revenue. Not just that, they have, because of the strategic locations, they have higher occupancy and high footfalls, which are greater than Inox in any of the last 3 to 4 years. Next, we go on to the F&B expenses, not just ad income, but in F&B expenses as well, they have seen a phenomenal margin of 70% because of their in-house production. That is not just that, because of also the spending per head that has grown, outperformed the peers that are there, and also they have reached the global levels which are at, if you compare it as a percentage of ATP. This is backed by their strategic tie-ups with all the top mall developers in the country. Next is that because of all these factors, the FNB has grown at a CAGR of 16%. Basically, because of three fundamental reasons which are underlying. First is that the household expenditure has grown significantly in the last few years, and also household expenditure on the movie theater has also grown. And urbanization obviously will give a big impetus to the both FNB and your ad income. And the final and the last key factor that is supporting our recommendation is GST implementation, which will straight away bring an EBITDA margin increment of 400 basis point. As the entertainment tax will be brought from 27% to 18% as the slab has been decided now. Though FNB sales will have a negative impact, tax credit on the expenses will counter it. Also, before that, we had done an analysis on the whatever the probable GST rate would be. As it has been decided at 18% would be the rate, we have a PAT margin of 300% as we can see. Next, we'll move on to valuation, which will justify our recommendation.
We have done relative and absolute valuation. In absolute valuation, revenue expected to grow at 25% CAGR. The beta value is 0.71, WACC is 10.25, and the perpetuity growth rate we assume is 3%. Based on these assumptions, we arrive at an intrinsic value of 1311. We also done relative valuation using domestic and international peers. Using domestic peers, the EV by EBITDA multiple is 9.2, which indicates that PVR's multiple is 15.5, indicating PVR will trade at 30 to 40% premium as compared to its domestic peers. We have done relative valuation using international peers, where the EV by EBITDA multiple is 12.3, which indicates that PVR will trade at 25% premium as compared to its international peers. We have also done a regression analysis where we arrive at a share price of 1462, which using the EV by EBITDA multiple, which we have included in the appendix slide. Using the trading multiples, the EV by EBITDA is 12.75, which translates into a share price of 1205. The EV per screen comes out to be 49.65 multiple, which translates into a share price of 426. Following is the football field analysis based on the different valuation methodologies that we have used. Using weighted valuation, that is DCF, relative valuation, and Monte Carlo simulations, we arrive at a target price of 1310. This is a DuPont analysis. In 2016, the return on equity is 13.7%, which will gradually rise to 19.5% by 2019. Following is the Monte Carlo simulations, where we have run 5,000 iterations. 60% of the simulations indicate a buy recommendation with an average price of 1306. Following is the 1 year forward price as per the Monte Carlo simulations. These are the P and EBITDA band charts, enterprise value by EBITDA band charts. So historically, PVR has traded above the average EV by EBITDA and P band chart multiples, and currently the P 2017 P multiple is 34 and EV by EBITDA multiple is 15.5.
Moving on to sensitivity analysis, we have done sensitivity analysis for PVR based on six major factors, namely footfall, ATP, which is average ticket price, F&B revenue, expenses, and cost of equity, and as well as long-term growth rate that we have considered in the appendix. And then we moved on to investment risk. So mainly we have divided investment risk into three parts: structural risk, which takes care of the industry risk; sensitivity risk, which depends on the external economic factors; and growth risk. We have calculated the risk on the scale of 1 to 9, 1 being the least risky and 9 being the highest. And then we calculated the weighted average for all these three risks, and we came at a overall risk for PVR to be 4.27, which comes in the mid to low risky level as compared to when we did the investment risk analysis. Now these are the ratings given by some of the agencies, but to come up on our own rating, we have developed this model in which we have considered these five main parameters which are taken by Moody's to analyze the global movie exhibition business. And from these parameters, then we again gave our own grading to each of the parameters, and we came up on a weighted average rating of A3, which is an investment rating. Summarizing the entire risk analysis that we have done, this is the impact of risk versus the probability matrix, where we have plotted all the important risks that we have undertaken.
So corporate governance is a vertical part of the PVR, which is very important for it. And the corporate the credit it values the particular analysis of the industry, and we have analyzed the multiple factors which are on the basis of which we are come to the conclusion that it is very good for the investment analysis. These are the factors: Atmas score and Petrosky score, which is very important for the PVR industry, which shows the strongest health of the company.
After the overall analysis that we have done, this is the final recommendation that we are making, which is a buy recommendation because the stock at present is underpriced. We feel an upside potential of 19.1% with a target price of 1310 because of the 4 reasons that has been discussed by us. Thank you.
Shall we start? You have taken, I think around 9% growth in revenues, ATP, this. Do you think it will sustain when it expands to tier 2, tier 3 cities? And have you done any income segmentation in your projections with that?
To understand the impact of this, we did our primary survey and we had done it in the major metro cities, also in tier 2, tier 3 cities. When we spoke to them, then we came to the conclusion that they are ready if they get an unique experience that PVR offers. Generally, we feel that PVR gives extra leg space, a complete package of entertainment that they are looking for. So if we ask them whether you are ready to pay a premium on the price that they are charging, and they are saying there is no other entertainment option, and this price is not more which they feel they can. And other factors that can work for PVR is that the favorable demographics, because as we can see, the age group in India, it is moving on an average we can see to 28 years, and we have the favorable demographics as well as the disposable income increasing. So these impacts we don't think so when they increase to the tier 2, tier 3 cities, because they are already at the premium position in the metropolitan markets. Now they have said that they are trying to increase organically into tier 2 and tier 3 cities where still there is an opportunity to grow, and we feel that these factors would definitely work in their favor.
Plus, so there is one more point. In the tier 2 and tier 3 city, we see that the penetration of all the other digital media is very less. When we see Netflix and the Amazon Prime which is coming now, that penetration is less. So mainly their source of entertainment is movie business.
That still does not answer why ATP will move up, because structurally ATPs in tier 2, tier 3 would be lower, whatever, even if you give the same product as tier 1 cities, the ATP would be lower because the real estate cost and the allied costs are lower. So you are compared to historical inflation in the ATP, you are assuming a much aggressive ATP growth going ahead.
So sir, the main reason for ATP growth is you see now in the movie exhibition industry or in the production industry, the technology is changing rapidly. More and more movies are going towards 3D technology, IMAX technology, and it is happening in the tier 2, tier 3 cities as well. The 3D movies are going there as well. And if you see for these 3D technology movies, the average ticket price is also increasing.
Not only this factor, now recently they have acquired DT Cinemas. If we compare the average ticket price of PVR, it comes to around 178, whereas for DT Cinemas it's up to a level of 257 per screen. So if we take all these factors into consideration, plus they have entered into a joint venture with a group in South Korea where they are installing 4DX technologies across 12 markets in the country. So if these technologies enter gradually into the tier 2 and tier 3 cities, what other peers are offering, because generally in tier 2, tier 3 cities we have single screens, and single screens are never a threat to this, because single screens are gradually closing down. So we feel because of the premium that they are charging in the metropolitan cities and in the tier 2, tier 3 cities, if there is slight increase, then the overall ATP impact that we have shown, it would be at that level itself.
Couple of points. One was on your industry where you showed a huge growth potential. But in your slide itself, you are showing that the total number of screens in the country have reduced over a period of last 7-8 years. So how do you reconcile both? That's point number one. And secondly, are you sure that GST rate of 18% has been finalized?
So answering to the single screen theaters are decreasing, but the multiplexes are increasing, because single thing, it's not.
Your slide shows total number of screens, right? So assuming that multiplex has 5 screens, 8 screens,
Yes.
it's already taken into account.
Oh, but the overall screens are going to increase because PVR itself, if you look at PVR, they have definitely.
Go back to the slide. Second, third. There is a slide of number of screens in the screen assignment. Yeah.
Yeah, so.
So 2100 is number of screens of the multiplex, right? So 6000 plus 2100, 8100.
Yes.
It's lower than the 7-year-old number.
Yes.
So how do you reconcile growth vis-a-vis this?
So because the multiplexes, they are not acquiring the single screen theaters. So they want to follow a model where they are independently going into the malls. So it will take time because PVR itself has projected they will keep on.
You're not getting my point is you said there is huge potential in it. If it is so, with such a growth market, then even single screens would have survived. There would be more people coming with multiplexes. So number of screens overall would have gone. That has not happened over the last 7 years.
So because if we talk about running a single screen theater, it is not at all financially feasible to run a single screen theater. So single screens are shutting their business, and whereas multiplexes, they want to grow gradually, because if we compare to the other markets like the US and the China, we are way below than the total number of screens if we are compared to them. Even if we have double number of films releasing than that of China. So these growth, if we are taking into consideration, because PVR has specially mentioned we are not going to acquire any single screen theater. So definitely there will need malls to come up or few other properties or other areas where they can develop. So this is going to take time. But as we can see, the overall factors that it is dependent upon, the entertainment industry, people are more and more, because in India it's clear, entertainment, if we talk about entertainment, then only people see an option on weekends or some other friend outing, we go for a movie. Because it's in the mall, we have an enriching experience. So because of that kind of experience, we see there is still a great potential, because tier 2, tier 3 cities are still unexplored. The metro cities, they are, yes, almost saturated. But the tier 2, tier 3 cities, majorly people just experience single screen theaters. But we are confident that yes, definitely this will increase, because we have seen that happening in US as well as China, when demographics become favorable and the disposable income increase. And same is the condition that India is in. And also the GST rate, because it was 18 to 25%. So in our financial analysis, we have taken into consideration 24%. But for various other rates, as we have shown, we have done it for 18%, 20%, 22%. If it is 18%, which is, I mean, a more favorable case for PVR, then it would impact 350 to 400 basis points. Otherwise, even if it is 22%, then also they will get a benefit of around 150 basis points. So, and it won't go above this bracket that we are sure about.
Actually, the point on GST was that Honorable Arun Jaitley, our finance minister, came up and gave us the 4 slabs that will be on which the GST rate will be applied. So, from the industry analysis that we have done, so it's more high. So it's very likely that 18% would be the one on which the film industry will fall in.
Just one issue which actually Harsha also asked last time was that there is a general tendency of comparing the demographics with US or China. Don't you think it is right to compare the right kind of population in those demographics, in the sense that the segmentation with respect to income bracket and the affordability, because I think affordability is the key metrics here. And I didn't see anybody talking about it in terms of whenever you are saying that because of positive demographics this industry is likely to grow, and because US did this and China did this. But have you studied the affordability factor when you talk of growth and all these metrics?
studied is we generally looked up to the disposable income that it is increasing of overall in the country. We had a study published a week back in the Mint which showed a detailed analysis, and it reiterated with the fact that we had already incorporated. And to understand more about the affordability factor, when we went to tier 2 cities like Nasik and when we went to cities like Mysore, when we interacted with people lining up for watching Dear Zindagi, when we watched with them, when we interacted with them, they were like, yes, it's a unique experience that we are getting. So if we have these things and the prices, if we ask them whether you have compared it with Inox or other theaters, they say yes, definitely there is something, some loyalty factors and the overall ambience that PVR offers, because of that fact we have become loyal to PVR. So we come here, and if we say even if the price increase by 10% or 15%, then he says if it's increasing over the years, then we don't mind. But if there is sudden increase, and if we don't have other methods.
Thank you.